Hello, and welcome back to At Your Pace Online's Michigan Real Estate Education Series. In this class, we'll be discussing real estate financing. We'll begin with a discussion of loans and the different types of loans. After that, we'll examine the sources of money used to fund loans. From there, we'll cover financing and credit laws with a special focus on predatory lending practices. We'll conclude the class by talking about the specifics of real estate financing in Michigan. The acquisition of property isn't always something that can be paid for out of pocket. This is where lending institutions enter into the process. Loans and loan money are a critical part of acquiring property. Since real estate agents assist their clients through the process of purchasing property, they need to know how the financing of real estate is carried out. Before discussing loans, sources of loans, and the application process, it's necessary to review a few terms. Specifically, we'll need to talk about loan-to-value ratio, origination fees, equity, and discount points. Remember, the loan-to-value ratio is a way for a lender to calculate the risk associated with lending money to someone interested in purchasing a piece of property. The amount of the mortgage loan is divided by the value or purchase price of the property in order to generate a percentage ratio. The higher the ratio, the more risky the investment is assumed to be. This is because the LTV ratio looks at how much money is being loaned compared to the value of the property being financed. The more money a lender provides to cover the cost of acquiring a property, the more risk the lender assumes. Conversely, the more of the property value the buyer can self-finance, the more assurance the lender has that the loan will be paid off on time. Lenders generally will have a maximum loan-to-value ratio. If a borrower needs more than that, they may need to end up paying more for the loan, a higher down payment, or may be denied funding altogether. An origination fee, sometimes known as an underwriting fee, is a fee charged by a lender to process a new loan application. This fee is usually between 0.5% and 1% of the value of the loan. An origination fee is intended to pay for the time and effort that goes into determining if money should be lent to a particular borrower. The origination fee must be included in the loan estimate that the borrower must receive. The equity of a property is equal to the market value after subtracting the amount of outstanding debt that is owed against a property. Outstanding debt can come from a mortgage, a loan borrowed against the property value, and liens levied on the property. Equity can be seen as the amount of money a property owner would get from selling the property after paying off any creditors. Discount points are an optional fee that a borrower can pay, which reduces the interest rate on a mortgage loan. Generally, each discount point decreases the interest rate by 1/8 to 1/4%. In other words, if a loan has a 7.5% interest rate and the borrower buys 4 discount points that are each worth 1/4 percentage point, the interest rate would be dropped to 6.5%. 1/4 times 4 equals 1. The trade-off on the discount points is the cost. The standard price of a discount point is 1% of the value of the loan. If a loan has a value of $600,000, the borrower would owe $48,000 for those points. The ultimate benefit of discount points is determined by how long a borrower intends to keep a particular loan. There's a break-even point in time after which the borrower has saved more money than was spent on the points. So, say we have the $600,000 loan with the initial 7.5% interest rate and a 30-year mortgage. Let's assume that the borrower still buys 4 discount points for $48,000, which lowers the interest rate to 6.5%. The monthly payment at 7.5% would have been $4,195.29. The monthly payment with the reduced rate of 6.5% would be $3,694.30. The difference in monthly payments is $500.99. This means that with the discount points, the borrower is saving over $500 a month. To determine the break-even point, we would divide the cost of the points by the amount of money the borrower is saving on monthly payments. $48,000 divided by $500.99 equals $95.81. After 96 months or 8 years, the borrower would have saved enough money to effectively make back the cost of the discount points. If the borrower liquidates the loan before that point, they would end up losing more money and negating the benefits of the discount points. With this information in mind, we'll now move on to examine loans that are used to purchase real estate.